Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is July 24th of 2023. Hope that everyone had a good weekend. We're going to have a bit of a shorter presentation this week just because the week in review was pretty quiet. Now, while it was quiet, there was a couple of important developments. As everyone knows who's been following us over the last 3 or 4 months, we've really been pressing home this message that technology is in a very, very dangerous bubble. Yes, AI is a real thing. AI is going to impact our society, but the equity values of a lot of these AI-driven stocks is way out of step with reality. And it reminds us a lot of the internet in 2000. Yes, the internet was real, it was going to change the world, it was going to revolutionize business models and the consumer experience, but a lot of the stocks at that time were way out of reality. And we think AI is in that same boat right now. So we're expressing very deep skepticism and caution as it relates to these stocks. I think you saw the first couple of soldiers fall last week. We're talking Tesla and Netflix taking huge hits after reporting earnings. And we think this is just the first inning of that. We expect follow through in that selling. But most importantly, we think that the market's going to start to revert back towards some of those value areas of the market, such as energy and such as the commodities in general, and copper and gold and industrials and the banks and all these areas that have been sort of unloved as money has been sucked in to technology. So that's how we're positioned right now, and that's what we're going to talk about this week as it relates to the overall market. And the title reflects that, is Tech About to Crumble, How to Prepare. Now, obviously, the easiest way to prepare, if you believe that thesis, that tech is in a bubble and about to really sustain a 20% plus drawdown, as we suspect, is sell tech, right? And we don't own a whole lot of, if any, technology across our portfolios. And so the three things that we want to focus on this week, aside from that technology bubble, is, has inflation already bottomed? And if it has bottomed, that does have important implications as it relates to technology and other asset allocation decisions. Number two, what do we believe has performed well during other times of reflation? And when we say that, we're really saying, looking at the actual events that took place in history, what has performed well? Lastly, the setup for small caps, energy, and copper. So, as it relates to the overall market and some of those downside risks, as that technology bubble has percolated and has blown up into astronomical proportions, what we've seen is a lot of that consensus bearish positioning has been completely thrown out of whack. So what I wanted to show here is the blue line is where positioning and sentiment is today, and the red dot is where it was at the beginning of the year. So when we look at the AAII Bull Bear survey, almost everyone was bearish at the beginning of the year. Obviously, bullish as it relates to consensus positioning and where we think markets go in the future. Right now, almost everyone is bullish. So that is something that we want to be aware of going into August, going into September. Obviously, seasonally weak periods of the market, but most of this bullishness is actually really centered around what's driving the market, which is technology. When we look at the put-call ratio, the put-call ratio started very high as everyone was buying puts. Now everyone's buying calls. We look at S&P 500 QQQ and IWM flows, very hot flows into technology. Small caps starting to receive some of that, but mostly around technology. And so if we go all the way across down the line here, what we see is a evolving picture where people have remained, people that were bearish are now very, very bullish. And that's we want to be careful with those types of conditions. We look at the triple Q here, which is the NASDAQ ETF. You can go back to the 200-day moving average and still be in a positive trend, and that's a 21% correction from down here. So again, we're very, very concerned with what's taking place in technology and what that can mean for underlying portfolios. Inflation. Disinflating for the better part of the last year. We've been very strong in that message. One thing where we have changed in the last month or so are signs that inflation is beginning to bottom at a higher level. So we want to track that closely, understand what it means and what the dangers are and opportunities are from a more reflationary cycle from this point going forward. So what I wanted to show everyone here was the blue line is the price of oil, and the red line is the price of gasoline at the pump. Okay, and this same line can be drawn for wheat, for corn, for lumber prices, you name it, right? So whether it's the soft or hard commodities, these patterns are the same. So I didn't want to make this chart too crowded. But the two that most people relate to, oil and gasoline prices. So we saw here is it peaked in mid 2022, and sure enough, inflation started to peak out thereafter. What we're now starting to see is, yes, CPI or inflation came down quite dramatically last month, but notice what's happening underneath the surface. We're starting to see oil bottom. We're seeing it in our portfolios. It's our biggest overweight position. We look at gasoline prices at the pump and that red line also breaking out to the upside. When we look at the soft commodities such as wheat or corn or lumber on the hard commodity side, doing the same thing, starting to inflect higher. So food prices, gasoline prices, oil prices, chemical prices, these things are all starting to swing back to the upside. So we do think here that inflation has largely bottomed around the month of June. CPI is a backward-looking indicator. We're paying attention to the forward-looking indicators. What does that mean? Well, during times of reflation, commodities tend to do better, right? So when we think back to 2022 when rates started to break out to the upside, energy did well, the banks did well, right? Those two areas in particular, and then other commodities such as copper did quite well. So we think we're going more into this cyclical pattern in the stock market where some of these tech defensive positions could be sold in favor of cyclical stocks. In particular, we really love energy here. We really love copper. We really love gold. Those are the areas that we're focused on right now. And we look at the commodities versus the Dow Jones, and you can do the same for the S&P 500 or the Russell 1000, et cetera. The valuation of commodities relative to the Dow is near all-time lows. We really truly believe that commodities is where technology was in 2011. It's why we're no longer technology investors after being hardcore tech investors for the better part of the last 12 years. We have made that giant pivot in the portfolios after 2022 was clearly a struggle. We think this is where the next 10 years lies, is in commodities, is in hard assets over soft assets. This is where we want to direct our time and our energy on at this point. And the other big asset class that tends to benefit from a reflationary cycle are small caps over large caps. In fact, this chart here on the left is the Russell 2000 relative to the NASDAQ, okay? Right now, the Russell 2000 relative to the NASDAQ is at all-time lows. So you tell me when you look at this chart, where does the risk reward lie? Does it lie to be long in the NASDAQ or in the small caps? We want to take a contrarian position here, especially when we think rates are inflecting to the upside. Reflation is inflecting to the upside, which tends to benefit value over growth. Value over growth tends to align with small caps over that NASDAQ 100 index. And we already see signs that that rotation has started, right? Now, we had a big week a week ago. We had a pretty good 3 to 4 week stretch here in the portfolios. And we see that reflected here in discretionary relative to energy and technology relative to energy. We see here discretionary and tech was market leadership over the last 3 or 4 months, but it started to break down and really peaked out in late May, early June. And since then, yes, every once in a while you get a big day in technology and everyone talks about it, but underneath the surface, you're continuing to see lower highs and lower lows for discretionary relative to energy or consumer relative to energy, as well as technology relative to energy. So in other words, energy is beginning to inflect higher at the expense of technology, at the expense of consumer stocks. We're seeing the same thing in copper, right? So the metal, despite all the negativity around the economy in China and the emerging markets, copper continues to hold its ground, making higher lows and higher highs. But the only thing that's acting better than copper are copper stocks. So whether we look at Freeport or Southern Copper or other copper stocks that are out there, again, clear breakouts from longer term downtrends. And that's the only real change we made in the portfolios recently, is to increase our copper exposure. And why is that? If there's only one commodity that has a better supply demand dynamic over the next couple of years than oil, we would say it's copper. And the only thing that prevents us from taking an even higher weight in copper, there's just not a whole lot of copper stocks out there with decent liquidity. That shows you kind of where the industry is. And you can see that here with copper inventory. So this is copper. These are copper inventories going all the way back to 2010. We are near decade-long lows. It's only going to take one supply shock to send copper skyrocketing to the upside, in our opinion. We do see the world in a cyclical recovery next year. In addition to that, we also see clean energy and the spending that's going into that as being very copper intensive. So we do think we are on the verge of a super cycle for copper and for copper prices. And as we know, we look at energy here real quick. We've shown this slide many times, but I think it's one of the more important slides out there. Oil inventories continue to fall. Guess what? Russia and the Saudis are actually working together. They are executing on production cuts. We saw that actual evidence earlier this week. But then we look at energy, its earnings weight is almost 13% of the S&P 500, while the sector weight of the stocks is only 4.6%. We think the sector weight catches up to the earnings weight to reflect that reality on the ground. Meanwhile, technology is 26, 27% of the S&P. Earnings are only 19%. Again, we think that ultimately technology will shrink to reflect its earnings weight. So, bottom line here, ladies and gentlemen, the first major cracks have started to spread in technology with Tesla and with Netflix. Is every technology stock out there going to bomb? No, of course not. But the one company we didn't mention in this report was Taiwan Semiconductor. I want everyone to go back and look at that report for Taiwan Semiconductor. Perhaps one of the most important companies on the planet, where most semiconductor production is centered on. They do most of the world's semiconductor production out of their fabrication facilities. Demand is weak. And AI is but a small sliver of most of these companies' revenues. And Taiwan Semiconductor is warning investors about that. Yes, it's great that there's a lot of hype and everything around that, but it's going to take years to build out. So 3 things, again, Tesla and Netflix, opening acts of that bubble unwind. There are signs that disinflation has ended and that reflation may be upon us. We think energy, copper, and gold benefit from that tech unwind, plus that reflationary resurgence. So that's what we got for you this week. 888-543-3776 is our number. Please feel free to reach out to your advisor and have a fantastic week. Thank you.